What happens when someone cannot pay back a loan? If you borrow money and cannot pay it back, you default on your loan. Defaulting on a loan can cause bad credit, which means you cannot be trusted to pay back what you borrow. A bank will be less likely to give you a loan next time if you default. Do you remember what a budget is? When you borrow money for really big purchases, make sure you have enough money to make payments. Find out if your loan has an interest rate that will increase at some point. If so, make sure you have money in your budget to cover the higher payments when the rate increases. If a homeowner defaults on a mortgage, the bank takes the house. This is called foreclosure. In general, most people do not default on home loans. Since 2005, however, there has been an increase worldwide in the number of foreclosures. In the United States alone, there have been over 10 million in that time. The case study on page 37 explains why. Foreclosure. Prior to the 1990s, banks had strict rules about who could borrow money to buy a house. People needed to have good credit, and they needed to make a down payment or pay some money at the time they got the loan. However, banks began to make it easier to borrow money. Banks started lending to people with bad credit, and they did not always require a down payment. These were called subprime mortgages. Banks also offered very low interest rates for the first year or two. Millions of people jumped at the chance to own a home, but many did not figure out what they would have to pay once the rate increased. For some people, this monthly payment doubled. As a result, many people could not pay their mortgage. This graph shows the increase in U.S. foreclosures between 2005 and 2009.